Every time someone requests an Uber, a transaction begins that most passengers never think about. A driver accepts the trip, completes the ride, and receives a payment. But the amount the driver receives and the amount the passenger pays are not the same number. Between those two figures sits Uber's cut, a percentage of every fare on every ride in every city where the platform operates. Uber does not own a single vehicle. It does not employ the drivers. It does not pay for fuel, insurance, or maintenance. And yet it collects revenue from every trip completed on its platform, around the clock, across thousands of cities simultaneously. This is the story of how Uber built a transportation business without owning any transportation, and how the financial architecture behind every ride generates revenue at a scale that would be impossible through any traditional model. To understand how Uber makes money, you need to understand what Uber actually is. It is not a taxi company, it is a marketplace, a two-sided platform that connects people who need rides with people who have cars and are willing to provide them. Uber owns neither the supply nor the demand, it owns the system that connects them, and like every marketplace, it charges for that connection. Before Uber, the transportation market in most cities was fragmented and inefficient. Taxi fleets required significant capital investment in vehicles and licenses. Dispatch systems were slow. Pricing was fixed and regulated. Supply and demand rarely aligned well, which meant passengers waited and drivers sat idle. The experience was inconsistent, the pricing was opaque, and the technology underpinning it had not changed meaningfully in decades. What Uber recognized was that there was an enormous amount of unused driving capacity already present in every city, and people with cars, time, and a willingness to earn. And that the missing piece was not more vehicles or more licenses, but a reliable, real-time mechanism for connecting that capacity to people who needed it. Uber did not create drivers, it organized them, and it built the financial infrastructure that made the organization profitable. The core of Uber's revenue model is the service fee it collects on every completed trip. When a passenger requests a ride, Uber's system calculates a fare based on several variables simultaneously: the estimated distance of the trip, the time it is expected to take, the current level of demand in the area, and the type of service the passenger has selected. The passenger sees this fare before confirming the ride, which removes the uncertainty that historically made passengers uncomfortable with metered taxi pricing. When the trip is completed, the passenger's saved payment method is charged automatically. There is no cash exchanged, no negotiation, and no tipping required. Uber collects the full fare, retains its percentage, and transfers the remainder to the driver. The percentage Uber retains varies by market, by trip type, and by the specific terms of its agreements with drivers in a given region. In general terms, Uber takes somewhere between 20 and 30% of each fare as its service fee. The driver receives the remaining 70 to 80%. This split is applied automatically to every trip without any manual intervention. The calculation happens within the platform, the payment is processed through Uber's payment infrastructure, and the driver's earnings are deposited on a regular schedule, or made available through an instant transfer option that Uber also charges a small fee to use, generating an additional minor revenue stream from the same transaction. In addition to the base fare, Uber collects revenue through surge pricing. When demand in a particular area exceeds the available supply of drivers during rush hour, after a major event, during bad weather, or late at night in busy urban areas, Uber's algorithm automatically increases the fare multiplier applied to trips in that zone. This higher fare serves two purposes simultaneously. It incentivizes more drivers to come online and move toward the high-demand area, which helps rebalance supply and demand, and it increases the total fare collected on each trip, which increases the absolute dollar amount of Uber's percentage cut, even if the percentage itself remains unchanged. Surge pricing is therefore both a supply management mechanism and a revenue amplification tool built into the same system, operating automatically without any human decision-making involved. Uber also operates several distinct service tiers within its ride-hailing product: standard rides, larger vehicles for groups, premium options with higher-end cars, and others depending on the specific market. Each tier is priced differently, and higher tier services generate larger fares. Because Uber's revenue is a percentage of each fare, a premium ride that costs 3 times a standard ride generates roughly 3 times the revenue for Uber at the same commission rate. The existence of multiple tiers allows Uber to serve different price points across the market while naturally increasing total revenue as riders self-select into higher categories. Beyond ride-hailing, Uber operates Uber Eats, its food delivery platform, which applies the same structural model to a different transaction. Restaurants pay a commission on each order placed through the platform. Delivery drivers receive a payment per delivery, from which Uber retains its share. Customers pay both a delivery fee and a service fee on top of the food cost itself. In a single Uber Eats transaction, Uber is collecting revenue from multiple parties simultaneously: a commission from the restaurant, a service fee from the customer, and a margin on the delivery payment. The per-order revenue structure is more layered than a simple ride, but it operates on identical marketplace logic. Uber facilitates the transaction, ensures the payment flows correctly, and takes its share from multiple points in the process. There is also Uber's subscription product, Uber One, which charges members a monthly or annual fee in exchange for discounts on rides and food delivery, waived delivery fees, and priority support. This subscription generates predictable, recurring revenue that is entirely separate from the per-trip commission model. It also serves a retention function. Members who are paying a monthly fee have a financial incentive to use Uber rather than a competitor in order to get value from their membership. The subscription and the marketplace commission reinforce each other, with the subscription deepening the relationship and the commission monetizing the activity that relationship generates. The reason this model works comes down to what Uber provides in exchange for its cut. For riders, it provides convenience, a reliable, cashless, on-demand transportation option with upfront pricing and a consistent experience that works the same way in any city where the platform operates. For drivers, it provides something more fundamental: access to demand. A driver without Uber would need to market themselves, manage their own bookings, handle their own payments, navigate their own disputes, and build their own reputation from scratch. Uber replaces all of that complexity with a single app that delivers ride requests directly, handles every payment automatically, and provides a feedback system that builds driver credibility over time. The service fee is, from the driver's perspective, the cost of accessing a customer base that Uber spent years and billions of dollars building. The model is further reinforced by network effects that strengthen as the platform grows. In any given city, the more drivers are active on the platform, the shorter the wait times for riders. Shorter wait times make the platform more attractive to riders, which increases the volume of ride requests. A higher volume of ride requests makes driving on the platform more financially rewarding because drivers spend less time idle between trips. More financial reward attracts more drivers. Each side of the marketplace improves the experience of the other side, and the cycle continues. Uber collects its percentage from every transaction that the cycle produces. What makes this model scalable at a global level is that Uber's expansion into new markets does not require it to purchase vehicles, hire drivers as employees, or build physical infrastructure of any kind. Entering a new city means launching the app in that market, recruiting drivers through incentive programs, and running marketing campaigns to attract riders. The capital requirement is a fraction of what a traditional transportation operator would need to establish the same presence. Once a market reaches sufficient density, enough active drivers to keep wait times low, and enough active riders to keep drivers consistently busy, it becomes largely self-sustaining and begins generating revenue with relatively modest ongoing investment from Uber. The technology platform that handles matching, routing, pricing, and payment processing is already built. It does not need to be rebuilt for each new city. Each additional trip processed by that platform generates revenue at the margin with minimal incremental cost to Uber. The fixed cost of maintaining the technology is spread across an ever-growing volume of transactions, which means the unit economics of the business improve as scale increases. What Uber demonstrates is a principle that runs through many of the most significant businesses built in the last 2 decades. The most valuable position in a market is often not ownership of the assets that perform the work, but control of the coordination layer, the system through which work is matched, managed, and paid for. Uber does not move people. Drivers move people. Uber owns the demand aggregation, the matching algorithm, the pricing system, the payment infrastructure, and the trust mechanism that makes strangers willing to get into each other's cars. That layer, invisible to most users, essential to every transaction, is where the business actually lives. Every ride that completes on Uber's platform is a transaction the company did not perform, but nonetheless profited from. The driver provided the vehicle, the time, and the labor. The rider provided the fare. Uber provided the system that connected them and collected its percentage for doing so. That gap between performing the work and owning the system through which the work is organized and paid for is not incidental to Uber's business model. It is the entire point of it.